All right, so this is week two. We'll be discussing tax planning. Um, and so hopefully this would be the first day after a due date. And so be doing my best to work through all of our week one materials with you guys and give you some feedback early on, as much as time permits. I do have pretty busy end of the week, but I'll try to get those. And if I don't, then over the weekend, I'll at least gnaw on them a little. Sometimes, if I have time, I will give feedback, and then go back through and give grades. Really, probably that's just a step for me to um, kind of look through it once, look through it again, and check what you've done with the syllabus. But before we dive into tax planning, I did want to give you a little more guidance on, the rhythms in this class. And the biggest one sometimes is that we are building a financial plan, right? For this case, this would be for, I've got it right here, the Lopez family, right? And so this is like the biggest part. Blurred. This is really the heart and soul of what the capstone is about. And so just keep that in mind that as we work through the material, I will grade those with as much possible feedback as I can. And the reason is pretty simple, right? I want you to be able to apply that moving forward for your final project. So some strategies that students have used in the past would be to ensure that they're sharp with things is that they actually go ahead and make a few edits and adjustments to, say, the cash flow planning after they get feedback, so that at the end of the semester, you really only have to put it all together and make it look pretty, maybe add a table of contents and a few references to the final project. So that's kind of my thought. I've known students who have done that successfully in the past. What's challenging though is that it does involve taking a little bit of time out now and carving out some time to look into those things. Okay. So, um, all right, I've got a few things queued up for our class today as we begin a discussion on tax planning and tax preparation. Okay. And so I've got a few tools that I'm going to be using with you guys, to kind of show you that as well. One aspect of something that I think is really helpful is that I'm able to apply a practitioner's perspective to things. Okay, so like today, I'm going to create some planning tools through a software that we use, give you some like eyes on that. Hopefully, that'll be something that you find useful because we have to, in the financial planning field, there are a lot of tools out there for us. You have to kind of be a little picky and choosy which ones that you need to use as they apply to your clientele. I know 10, 15 years ago, the theme was always bigger, better, badder, more. And I know maybe I mentioned that in our last meeting. eMoney, Money Guide Pro would put out 150-page documents of things for clients. Recently, the movement has actually kind of pendulum has swung in the opposite direction, where a simplified financial plan, even going as far as to try to be able to fit one on one like piece of paper, normal computer paper, has been a theme. The one-page financial plan, I think, is even maybe a book now. Um, and I think there's a lot of, uh, point to that. I've seen it from clients myself that it's very easy for them to get lost in the numbers and overwhelmed by the numbers. And so I want you to think about that as well as you have went through this first step with the Lopez family, right? You maybe have noticed that it's easy to ask the question, well, I could just keep going. I could just keep adding more and more ratios or more and more assessments or analysis of, um, whether it's cash flow planning, financial statement, financial position, all of these different things, as well as all the ratios. You could eventually end up with a 15-page document. And I had some feedback from students in class that said, just how far should I go? And my argument was, well, actually wouldn't go I would go less deep, but more concise, but more practical, right? If you're looking at this from the lens of a client and you're trying to help a client understand things, making yourself sound smart, putting up a bunch of big, you know, uh, tables and spreadsheets might be like something that gives you um, credentials, right? Makes you seem like you know your stuff. But in the end, the client doesn't really have much takeaway from that, right? So I always tell students, especially when we're doing this cash flow planning, like you can keep this part simple, right? Simple and clean. Something that you can describe to someone in 5 or 10 minutes, something that maybe would only take about 30 minutes to collect, right? Of course, it's all here for us written in long form on a Word document, but we want to find the things that really, really matter, right? So for instance, you could find probably 15 different debt ratios, right? Are you going to use debt to income ratio? Are you going to use the current ratio? Or are you going to use other ratios? Well, just pick one or two that maybe most apply to this person in their stage of life. All right. If they're renters, maybe you do use a current ratio. If they have more mature and they've got a mortgage, maybe you use the debt to income ratio. But just the ability to kind of sift through the weeds is really important. All right, so let's shift the conversation to tax planning. Our discussion today will be on that. So I'll be sharing some different documents. I've got some things pulled up on websites as well that I'll be sharing. I think probably the biggest takeaway that I need for myself whenever I think about dealing with clients and taxes is that taxes get brought up a lot more than we would even want as planners. Um, and it is a very important part of the conversation with clients. That being said, it's a conversation that always ends up bringing up things that are common misconceptions. And so I always say, like, I need to make sure that I am in a patient place with my clients whenever I'm talking the tax stuff with them, because it does bleed through into everything that we do. But even more importantly, it is a little bit of a check to see if a client is well educated or just thinks they're well educated or doesn't even pretend to know much about personal finance. I found a lot of clients out there have a lot of misconceptions. Some of those are very simple ones, right? Sometimes it's just the difference between knowledge of how the tax system works. They oftentimes will assume that their top tax rate as they move through tax brackets is their marginal rate. Oh, well, don't want to make that extra money, or all my income will be taxed at 22%, not 12. And you have to kind of explain that's not how taxes work. And they should be happy about that. Taxes change often. That is like something that you have to stay abreast to. So my personal experience with tax planning began just as, a person, a bachelor out on his own after college, and my dad was very adamant that I would do my own taxes. He had been doing his own taxes on with a pencil and then with like all the different forms stacked in front of him. And that wasn't uncommon, maybe 15 or 20 years ago. It is uncommon now. Most of the time, I would say almost all the time, people are taking their tax preparation documents into a tax preparer, or they're having it done through an online website by themselves. Every once in a while, you'll have more complex scenarios as well, where they'll get a CPA and things. But my dad was like very firm that I should learn this, and he explained something that was important. He said, as you go through it, there are changes that happen every year, but you're developing a knowledge of how the tax system works that can actually work in your favor. And so the tax system, if you kind of just want to look at what it is from a philosophical place, other than the fact that like you have to pay taxes so that we can provide for goods and services for the nation and state and all the other places that in between, right? But it's more about especially for our federal taxes, and as we look at tax preparation and tax planning with clients, I'd say it's more about understanding incentive schemes, right, that the government sets up to help us out and help us make good decisions. Now, the odd thing is that a lot of times we make decisions throughout the year, and then we get to the very end of the year, right? and we're filing our taxes. And so, does it really work well? Do most people look at their tax obligation, tax breaks throughout the year? I think businesses do. Every once in a while, you'll have the eye-popping breaks on electric cars or renewable energy that individuals sign up for. But I'd say a lot of the time, people are not looking proactively at their taxes. They're looking retroactively, and they're only looking retroactively 1 year, right? And that would be like during this time of the year, it being March, looking back to what last year was like. And very few people look forward, make little adjustments on their taxes like they probably should. And so, just a simple kind of I'm going to start with before I get into before I get into our presentation. I thought I'd just start by giving you the simple skinny on taxes. So tax rates have changed. I mentioned that earlier, every year. And so the best way, if you were like, I want to know more about taxes, the best thing to do is do your own taxes. And then every year, as you see changes come up, they'll affect you personally, and they'll help you have a better understanding of how the system is and how it's changed. And so just this is kind of an overview. This is just for about 7 years of tax history, but we see at least dozens of changes, whether it's contribution rates, deduction rates, how standard deductions or itemizations are going to be. All of these different things have changed. And so if we look back, there was the Secure Act 2.0. I think that was 3 years ago. That was a big change in our tax laws. There was the Tax Cuts and Jobs Act. Actually, more recently was the big beautiful bill, the OBBBA, which changed tax rules, allowed for a small deduction to be taken starting in 2026. So people will be filing for this next year. Small deduction for charitable giving, but then also has some other rules as well. Elderly people, I think Trump had talked a lot about Social Security tax not being taxed, and he couldn't get that far down the line. That wasn't a realistic thing, but he did end up lowering taxes for anybody age 65 plus, and he did that by giving them an extra bit of itemized or standard deduction. And so they get an extra $6,000 per taxpayer in standard deduction, which is around $30,000, right? So you can describe this as like the textbook would show it to you. So here you're seeing the tax rates. I always kind of talk with clients in a different light. I begin with the tax-free income that we receive. And it does help to know like some things are not taxed, some sort of types of dollars are not taxed. For instance, Social Security has a portion of it that's not taxed already as well. Um, but knowing what does come and flow through on your taxes or not, I mean, most income is going to be taxed. If you're fostering a child, and receiving state income, sometimes that's not taxed. So, if you're, certain types of disability income, most are, but some aren't. If you're receiving money in settlement, that would not be taxed. If you're receiving life insurance proceeds, that would not be taxed, but most things are, right? So here's showing this is like kind of the tax rate for 2025. I actually begin by usually telling clients, hey, listen, we start with this. I start with the standard deduction, right? So most people are going to get $30,000 in standard deduction kind of off, right? So it's actually deduced from their income. That's why it's called the deduction. But that's kind of where I begin. And then at that point, right, then we can kind of, and this is for single payers, right? Married filing jointly would be here. They kind of go through these numbers, right? 10% to 12 to 22 to 24 to 32 to 35 to 37. I'll be honest, I deal with a lot of clients between the 12 and 22% tax bracket, right? And so that is actually oddly enough the biggest jump in tax obligation besides 0 to 10 is 12 to 22. And so there's a lot of things that can happen in the 12% bracket that are good, that when we push into 22% for a normal median income person, at least around our area, we have to kind of watch this limit here, right? And so this plus your standard deduction, usually about 100 and close to $130,000 a year. And so that becomes a limit for us in financial planning. We talk a lot about that with clients. Okay, because there are things you're okay with, paying that extra tax on. For instance, income, you don't have much choice. It's going to come in no matter what. You're probably not going to quit your job just because you're at a higher tax bracket. But take the idea of maybe Roth conversions. Roth conversions is a strategy where you have a choice to do it or not do it. Maybe do it in 12, but not 22% tax bracket. Right. So that's kind of the thought usually when it comes as a particular practitioner, how things work. But I will say, like, the thing about it is this right here, right? There's so much confusion about taxes. It seems, at least monthly, that I'd have to discuss with a client who's concerned with gifting money to a child, or concerned that their estate will be taxed. And I usually have to tell them you're probably not going to be hitting the $15 million mark, giving to worry about having estate tax, at least in our state and in most states. And so that's not the only confusion out there, but there is a lot of it, right? So all that being said, we use a couple. I was going to show you a little bit about the different tools that we use. Right Capital is a financial planning software, so it has a tax integration with it. I want you guys to go and watch. I'm going to post a video from last year, no, 2 years ago when I taught this class, and it has the financial planning software, Right Capital. I'll actually dig into it on that video. I think it's about 10 minutes in, and I kind of show you what we usually use it for with clients, and kind of a discussion that I take. I take a little side road down the kind of one of the bigger financial planning questions out there, the question of tax deferred versus Roth. And so, in a nutshell, right, as you think about saving into your retirement, right, you also oftentimes have that question, do I want to save into something that is going to give me a tax break now, but will grow and then I have a tax burden on in the future whenever I do retire, or would I rather not take the tax break now, and instead go the Roth route? Okay. And so then that's growing tax free and can be withdrawn tax free. And so I kind of talk about a younger client who has done a good job of saving into a tax deferred account. Um, and I mean, it's good. They've saved a lot of money, right? But it does present some challenges for tax planning that I kind of talk through on that video. So I'll post that as well as this one once we get done here today. The big story for me, I think a lot of this is a pretty hot topic in the world of financial planning, is to pre-tax or to Roth. The raw numbers tell you that it really just matters what your tax rate is. If your tax rate's higher now than it would be when you withdraw the dollars, it makes sense to tax defer, and vice versa. But there's a little more to it than that. There's a lot of behavioral aspects to the decision of Roth versus, a pre-tax choice. I see a lot of clients that don't want to spend their money out of a pre-tax account, because they know that it's going to come with a tax obligation and they don't like paying the taxes. That's and that so they kind of feel it a little bit, if they say call and ask for a $10,000 distribution, or they want to up their monthlies, that they know that that also will come with a higher tax obligation. And typically, the people who are good at saving are also the people who are a little bit more money aware, right? And so it becomes a difficult discussion with them. I have to help coach them through that. Like, hey, so what if we push through the 12% to the 22% tax bracket with a distribution this year? If you have a good nest egg, say $1 million, does it really matter, right? You're paying a few extra $1,000 in taxes this year, but you're going to at some point probably be in that category, or you're just not going to be spending your money. It's going to actually, compound, continue, even through your retirement. So if that's a question, right? Like if that's really going to be how you feel in retirement, would you rather save in pre-tax or Roth? It might lean you toward Roth. And then the other aspect is just simply the compounding effect, right? If we really truly believe, so most of you are all like young, right? So if you're in your early 20s, the question goes like this, like, do you believe in compounding? Like, hopefully the answer, if you're in this class in the capstone, is a yes, right? And so if you really truly believe in compounding, do you want the government to be a minority stakeholder in your compounding? Right? Because practically speaking, that's what happens when you save into a tax deferred investment option, is that they get 20%, right? And so if you're saver early and you've got an opportunity to take a dollar and let it grow to $8 or $10 down the road, right? The IRS, depending on what state you are, your state is going to get some of that. And so that is, for me, I think a big conversation point because most people don't want that. And practically speaking, right? So conceptually, it's just an issue of which is your highest tax bracket. But operationally speaking, it also does something to impact your cash flow, right? Because if you change your tax is, and that's going to be something I show you on the slides that I have, the PDF we have. But if I change your pre-tax to Roth, it's going to change your take-home pay, right? You are now sending more to the IRS for taxes on the money that you're putting into the retirement account. And so it actually is not an impactor on how much. A lot of times people say, well, you can save more into your retirement if you pre-tax it than if you Roth it. But practically speaking, that's not how people see it. People see it in their take-home pay, right? So you're either paying the tax now and seeing less dollars flow to you, right? And practically speaking, you're going to be able to have more, right? Roth is more dollars of mine than the pre-tax, right? Because pre-tax is probably going to be taxed at maybe say an average of 20%. So I get 80% of that. And so it just changes that optic a little bit. And so it's hard though, because like right now, right, in 2026, as I build out plans with clients, the discussion of Roth versus pre-tax, a lot of times whenever I work with someone who is a pre-retiree, that means they're going to be retiring soon, they didn't have the Roth option for very long. They might have been able to start their own Roth IRA in the 90s, but very few people did that. They might have only had the Roth 401k option at work. That was a Secure Act 2.0 provision that required workplaces start offering that. But some of them still haven't implemented it. I don't know how that's possible because that's now been 3 years since that policy has been enacted. But if you don't have the Roth 401k, you're not going to be someone to go out and invest on your own. So people just aren't. Then you probably don't have any Roth funds. And that means most of your dollars are in pre-tax, which means that there's going to be a lot of more tax planning. You might need a planner, right? And so that becomes a big discussion with our clients and something that if you look back in that video, I kind of show you the numbers of what say someone in their 30s that saved $400,000 in pre-tax has to look forward to, right? Which is great. That money's really going to grow. That tax obligation, once they hit required minimum distribution age, which is the age the IRS requires you to start taking money out of that account, it's really going to hit you hard. So if you could go back and watch, I think it's like minute, I don't know, it's a 50-minute video, it's minute 10 to 20. Okay. All right. This is another planning software of ours. It's called um, Holistoplan. And so I'm going to show you a little bit about this. Okay. Whoops. There we go. All right. So this software helps us dial in year by year tax obligations for clients and do it in a really accurate way. Right. So we use Right Capital for long horizon financial planning when we look out 10, 20, 30 years and help them make good decisions. We use Solistaplan here at our office whenever we're looking at trying to help clients understand just what their tax obligation will be kind of before year end so we can make good decisions. Now, there's a lot of different decisions that you could make, but I think the big one for us is usually Roth conversions. We'd like to help our clients convert money, especially when they can say, so of course, it depends on the client and size of accounts and, income expectation and things like that, how much they're going to be pulling from their retirements. But a lot of times we're just playing in the 12 to 22% tax bracket, right? So last year it's 130, depending on the retiree. If they get this extra big, beautiful bill deduction, it could be $140,000, right? So somewhere in that area, what we're doing is we're doing Roth conversions with them. So what we would do is we would add this information, we would put in, run a little scenario on here. Okay. And This is just the client like details. See if I can get the actual scenario of the place up. And so you could actually create an analysis. And what's cool is um, this will actually can scan uh, in someone's 1040, right? And then you can actually use it to figure out their tax obligation for the year before, kind of from that year, and then look at next year. And you usually ask the client, hey, has anything changed, right? So, say they had made some part-time income. Let's assume this was a retiree, right? So, like, let's just say they made $12,000 last year, selling tickets at the ball game or something. I don't know. And then let's say they had, 500 in taxable interest, 200 in dividends. Let's say they took out distributions of, you know, I don't know, $55,000. And just for the simplicity's sake, we'll just stop there, right? You can actually go down and kind of see what their tax obligations are. Here we're showing that they pay $6,000 in taxes, right? Their effective tax, this would be like a single guy, retirement, hadn't started Social Security, just living off of his part-time work and his IRA distributions, how much they would actually pay in ordinary income on capital gains. And then it helps us figure out if we wanted to do this, right? If we wanted to do a Roth conversion for a client, let's say we did decide on converting 5,000 to Roth. That 5,000 is going to be moving from pre-tax to Roth, so it's going to show us kind of like ordinary income. And so then we see, well, that costed about $1,100 to move 5,000 over. So that's how that works. Um, and these tools are wonderful, right? Because they give us an opportunity to quickly and easily create a client tax planning stuff that you have to do in the year, right? There are certain things you can do after year end, like continue adding to a Roth IRA for a prior year contribution. And then there are some things you can't, right? And Roth conversions you have to do in calendar year, not in tax planning year with the extra few months that they give you in wiggle room. So I'll pause there real quick. Any questions you guys have? All right, one more thing I want to talk about is this. We live in now the gig economy. So historically speaking, it used to be that people would just receive their income. They wouldn't even really need to worry about saving much for retirement because they had a pension. They would be getting Social Security. And we called that defined benefit retirement plans. And that would have been, the world of the 50s and 60s and 70s. And then in 1974, legislation was passed called ERISA. That meant that less pensions were being created and more employers were putting that burden of retirement planning on the client. Okay. And so that was known as um, uh, defined contribution plans, where all of a sudden you have um, the actual employee is responsible to make sure that they save into a big bucket of money, you know, uh, grow it so that eventually they can start spending it in retirement. We've kind of now transitioned for a lot of people, not a ton, but more and more every year into a new world, and that would be the non-employee compensation world. And so there are a lot of people out there who don't get any workplace benefits, but just receive a pile of money. So the gig economy is the perfect example of that. If you're door dashing or Ubering, you would probably receive a 1099 NEC, and then you would have had to been required to not only, we think about how our world has changed. Now you are required to take care of your taxes on your own and to figure out how to do quarterly taxes and make sure that everything is taken care of for everything. And that includes state or local tax if you have to pay. And so it's good to know how 1099 non-employee compensation works because not only is that the gig economy, but it's also something that we're seeing from like highly trained professionals. A lot of jobs out of Silicon Valley now involve people not getting paid through a W-2 wage, but instead signing contracts to work for a company and just receive cash up front, right? Or as they go, cash, just a pile of cash, right? And the company doesn't worry about putting them on the books, about making them employed, about giving them benefits. That all of a sudden becomes the non-employee responsibility to take care of that. And so this is an interesting world, right? Because self-employment tax, if you think about self-employment, right? Employment wages, if you're not self-employed, are typically paid 6.75% or 65% from you and the other from the employer, right? Employee, employer, add those two up between Medicare, FICA, Social Security, it should be 15.3%. Well, now the 1099 employee has to pay all of that by themselves. And so a lot of my clients come in, and some of these are gig people, some of these are also highly trained people making really good money, asking how to navigate that. It's probably a CPA discussion. If they really wanted to go find a tax preparer, they could have them do it. But having this, answers to these kind of things and planning in your back pocket helps. Always tell our clients, like, I'm not a tax preparer, I'm not a tax specialist, I'm not a CPA, but I can give you basic guidance and direction on this kind of stuff, right? So it's good to know how this works. It might even apply to you at some point down the road, because then the client will probably bring up the fact that they need to learn about how to get their own health insurance, right? To go in the marketplace and get it, or find a health sharing ministry. They might need to also figure out how to save for their own retirement, and that all of that impetus is on them, right? Not the employer. The employer loves it. They're maybe even able to pay them a little more in this type of an arrangement, but wanted to share that because that's something I've seen coming up a lot, a lot, a lot with clients is how do I do that, right? And how does that work? And do you need an LLC for this? And all this kind of stuff. And so it's like, well, yeah, you probably do, depending on your work, your line of work, need an LLC, but maybe not necessarily, right? You could probably be a sole proprietorship and do all those things in many of the same ways. All right, so I've got about maybe 10 minutes left. Kind of just dive into lesson three on income tax planning. The stereotype is that tax preparers tend to just look out year by year, what's coming in, what's coming out for people. We as tax planners, financial planners, tend to look at the long game, right? But it's good to know how taxes work so you can do a basic 1040. It's good to understand the implications of income. And so, riddled it down, 1040 is a statement of your income, okay? And then you get the deductions. And most of the time, people are either taking the standard deduction or itemizing. More people now are doing standard than ever before because it's become so big. The Tax Cuts and Jobs Act of 2017 doubled it from, say, 13,000 to 26,000 for people who are married filing jointly. And now that's above 30,000. And so that means that if you were to itemize, if you take your state and local tax, your mortgage interest, and your giving, among others, some other small things there, you have to push above the itemized amount or the standard amount in order to itemize, right? So that's the biggest deduction out there. But then you also sometimes have these other deductions, right? So you're reducing your adjusted gross income, okay, by deductions. Okay, at that point, you get your tax liability, and then you add your credits to it. Okay, and so a credit is a dollar for dollar break on the amount of tax that you have to pay. So in the end, the easy question on the quizzes that I used to always ask my personal finance classes, right? Would you rather have a $1 deduction or a $1 credit, right? And I think about 50% of them got it wrong. You better say credit. Um, Knowing a client's tax situation and where they are is helpful, right? There's all these different aspects of that as well. If they're self-employed, if they're contributing to a workplace plan, retirement plan, and all these other little things that also might play into it. Alternative minimum tax is a tax that's out there to help ensure that everybody is paying, right? So if you receive a ton of money from passive investments, right? That might trigger alternative minimum tax, and someone, typically a wealthy person, would still have to pay taxes. Um, Here it just kind of goes over these different issues that people sometimes have, okay, whenever they're dealing with not paying for taxes, right? This has actually been changed. This is the required minimum distribution from a few years ago. It's now age 75 for anyone born after 1959, so 1960 and beyond. The required minimum distribution is very tricky because there are people out there who don't know that they have to take money out of their retirement accounts. And then they finally get to the point where they're a little older, and then that becomes a thing that they're actually responsible for. Our office helps, and I think most everyone in the financial planning industry helps people make sure they satisfy that need. But it is on the client and a tax obligation. If they don't, it's a 25% penalty on what the RMD would have been. So it's pretty steep. Here are some different equations that are used. So one of them I think is kind of interesting, right? It's actually the tax rate on if you were to go out and buy bonds that don't pay federal or state or full tax exemption, right? So federal tax exempt are muni bonds. State tax exempt are muni bonds within a state that you live in. Full tax exempt if you've found a bond that is both federal and state tax exempt. So the market will discount these, right? This is a bond paying yield. Well, that yield is going to be lower on these because they're tax advantaged. And so you do the simple math to figure out from the exclusion ratio, if it makes sense. Basically, you're taking one minus what their tax rate is. So say you're at combined total tax rate of 27%, right? So that would be 0.73. You take that, what that interest or what your tax exempt bond yield would be divided by 0.73, and that should be either higher or lower than what you could get for other equivalent bonds out there, right? Say it's just a normal old government bond. That tells you whether or not to take the the muni bond if it's worth it or not. Taxes are really just flowcharts, okay? Just a ton of flowcharts out there. That's why computer software is so good at this. That's also why I think AI tools at some point will be coming very soon after the computer software that can run these, because as you can see, a lot of places you file for free, but even those that you don't can be a little expensive. And I will tell you that um, AI is going to be really honed in, I think, to being able to help create a free filing system for people as long as they're willing to trust it. And that's really the thing, right? Working with boomer clients, most of them don't trust even computer software. They don't even like putting their social security number into, TurboTax. They would rather go to a local tax preparer and have their taxes physically taken and then scanned into another software where the tax preparer will upload it and put all that information into a similar system and charge the client 5 to 10 times more than they would have if they'd used TurboTax. And so that's, I see a lot of, anytime I'm scanning in files, very honestly, very few people do their own taxes. A lot of people pay $300 or $400 for just a few minutes worth of work for a tax preparer, and that's fine, right? They can decide to do that if they want. I think they're usually don't understand taxes, are afraid to mess it up, and know that there's this feeling that there's less liability, that if the tax preparer did mess up, they go back and fix it. Um, so then you also have higher end clients that all use CPAs. And I might have talked with about this in our last class, but that becomes kind of the big job of a financial planner, is to go out and make connections with people, right, in your community, and whether it's estate planners, tax planners, legal planners, to help the client, that needs these things and actually has a complex financial situation that maybe would dictate their use of a CPA. And so just keep that in mind. But this is a pretty good little, flow that's showing kind of how to think about the taxes. Um, well, summation of talking about lowering your earned income, different breaks that you might get, and general tax strategies that are used. So feel free to if you will have questions about any of these different things, to holler at me. Um, talk about taxes almost every day with my clients. And that's okay, right? You end up maybe doing, a lot of times people think you're an investment manager, you wear that hat a ton, and you do wear it, but planning, where you actually get into plans and help people with cash flow planning and tax planning, are actually sometimes more prevalent. In every meeting it comes up, right? So that's one of those things where it's like maybe that's why we start with cash flow planning and tax planning in our curriculum these weeks. And so I'm going to stop there, stop the video, um, and feel free to let me know if you guys have any questions moving forward. Thank you.